Welcome to Multifamily Loan Talk, the podcast where we teach you how to use other people's money, i.e. the lender's money, to finance your multifamily deals. I'm your host, Roderick Jones, and on today's show, we have another loan review. So we are reviewing the Freddie Mac float to fixed rate loan product. Let's get into it. So I like to say that this Freddie Mac float to fixed rate loan product is a hybrid between a bridge loan and long-term financing. Let's see what they say about it. Okay, so we're here. So float to fixed rate loan is a 2+7. More cash up front when you need it. So basically Freddie Mac says we call this the float to fixed rate loan. No, basically they say we call the float to fixed rate loan a 2+7 because payments during the first 2 years of the loan are floating rate and interest only. And the following 7 years of the loan are fixed rate. So basically the borrower receives superior cash on cash returns through the first 2 years and can lock a coupon for the life of the loan at the initial closing. So here's the reason why I call this loan a mix between a hybrid or a bridge loan and a long-term loan put in one. So basically they said it's a 2+7. So what that means is in the first 2 years, there's interest only payments and the interest rate is not fixed. So it's a floating interest rate. And so when you do a bridge loan, you use this loan to do interest only and use it to fix up the property and do whatever you need to do. And then you cash out and refinance into a long-term loan. With this loan, it's a bridge loan. It's like a bridge loan for the first 2 years. And then the last 7 years, it rolls into long-term financing with the fixed income payment or with a fixed rate. So let's look into it. So we can see right here, what is this loan for? What is the ideal use of this loan? So the ideal use of this loan, or basically this loan is ideal for assets requiring light repositioning. However, this is not required. So there's no unpaid principal balance maximum. This eliminates risk for future treasury rate increases. It index locks. Index locks are available prior to rate lock. It's available for all conventional and affordable housing offerings except pre-stabilized assets, student housing, senior housing, manufactured housing communities. Supplementals are permitted on post-conversion, meaning that when you roll over into long-term financing, you can do a supplemental loan. And conversion of floating rate to fixed rate is automatic. So it's automatically going to convert from floating to fixed at that 2-year mark. So it's going to go from 2-year floating, fixed on that at the end of the 2-year mark into fixed income or fixed rate. So who is eligible for this loan? So we already know that this loan is it's ideal for assets that need light repositioning. Why do they say that it's ideal for assets that need light repositioning? Because it's like what I alluded to earlier when I said when you're doing that value add deal, you're going to use it to fix up the property some. And then once the property and the value has increased, you're going to go into long-term financing. And that's why they say this is the ideal loan for that, because it's going to give you more cash up front. So that way you can do that and then roll into long-term financing once it's stabilized. So eligible borrower must be qualified. So you remember we went over the eligible borrowers in the past, such as LLCs, corporations, all of that. Those are still eligible borrowers here, but it's just saying that you must have the experience to get this type of financing. So your floating rate period is going to be a 2-year period. It's going to be interest only. It's going to be no rate cap required. And you are locked. It's going to have lockout and no prepayment penalties, and there are no supplemental loans allowed during the floating rate period. All right, let's look at our fixed rate period. So we have a floating rate period for 2 years, and then we have a fixed rate period for 7 years, meaning that the total loan term is going to be a 9-year loan. So interest only on the 7-year fixed rate loan is subject to credit parameters with defeasance, meaning prepayment penalties. It's an amortizing loan with prepayment penalties and is securitization ready. Okay, let's look at underwriting. So underwriting, it must be compliant with current credit parameters. The size is based on the fixed rate. It's based on the fixed rate. And then it must pass the refinance test. And basically, the refinance test is at maturity, at maturity, when a loan matures, it's going to have a balloon payment. Can this property or the borrower refinance this loan at maturity and pay off the balloon payment? Meaning that if you have a $10 million loan and it's at maturity, your loan is now $9 million, will the property have increased in value enough to where you can pay off that $7 million loan with your new loan when you refinance? So it must pass that refinance test. Okay, let's look at pricing. So how do they price this loan? So terms of this loan is subject to revisions due to market fluctuations. So of course they have to put that in there. But your floating rate loan is priced on the 30-day average SOFR, SOFR, plus the 7-year floating rate pricing, plus 20 basis points. Your fixed rate pricing is based on the 7-year U.S. Treasury. So you look at the 7-year U.S. Treasury, you look at the 7-year fixed rate pricing, and then you'll add 20 basis points. So 7-year U.S. Treasury plus the 7-year fixed rate pricing plus the 20 basis points. That's how you get the rate for your fixed rate loan. Now, fixed rate is locked when floating rate spread is locked. Index locks are available during underwriting. So once you lock in your floating rate spread, that's when your fixed rate loan is going to be locked for those 7 years. And no future rate adjustment. So your rate won't go up and it won't go down. You're locked into that rate for the next 7. Okay, let's look at the process. Process and conversion to fixed rate. So conversion to floating rate is fixed. Conversion from floating rate to fixed rate is automatic. Meaning that it's not gonna be a surprise. You already know it's automatic conversion. Okay. Permits additional loan proceeds via supplemental mortgage pari passu. Okay, that's straightforward. Freddie Mac must receive requests for additional proceeds no less than 150 days prior to conversion. All right, for securitization purposes, updated third-party reports prior to fixed rate period. Third-party reports paid by Freddie Mac unless additional proceeds are requested. So Freddie Mac are going to request third-party reports, once it's time to convert the loan over into fixed rate. But you don't have to pay for that. Freddie Mac will pay for that. But if you request additional funds, then you will have to pay for the third-party report. All right, so if original loan fails to meet Freddie Mac's credit parameters at conversion, Freddie Mac retains the right to restructure the transaction via split note at the time of securitization. And supplemental loans are allowed beginning the 2nd year of the fixed rate period. So if you're going to do a supplemental loan, you can do that, but it has to be on the 2nd year of your fixed rate loan. Can't be in the first 2 years, and it can't be on the 1st year of your fixed rate loan. It must be on the 2nd year. Okay, and that is it for this product. So we just reviewed the float to fixed rate loan product. And this product is ideal for people who have assets that require light repositioning. So I'll call this the hybrid between a bridge loan and long-term financing, because it's like both put into one. You have 2 years of interest-only payments, floating rate interest-only payments, and then it converts into a long-term 7-year loan. You can use this loan for conventional affordable housing. If you need financing for your next multifamily deal, don't hesitate to reach out to me. I am happy to help you get the financing you need for your multifamily deal. Click the link somewhere in this bio or wherever it's at. And with that being said, leave a like, leave a review, leave us a comment, and subscribe to the podcast. See you on the next episode.